Jeff Bezos is a genius that investors should study, and these two quotes from him prove it. Jeff Bezos founded Amazon from his garage in 1994, and from those humble beginnings grew Amazon into a company that until recently was worth $1.5 trillion. According to Forbes, he's the 5th richest person in the world with a net worth of over $100 billion. And it seems like the only thing he's really lacking is validation from a no-name YouTuber like myself. That's a joke. All joking aside, my name is John Quast. Thank you so much for stopping by my YouTube channel, Working Capital. On this channel, we learn about money stuff, so we're going to look at these quotes and what we can learn from them. But it's also about taking action, and I think that there's insight that we can draw from Bezos that will help us in our own portfolio construction. It'll make sense as we go. The first thing that I really like about Jeff Bezos is he shows us how to lay a solid foundation. In developing a business strategy for Amazon, everything was built around what wouldn't change. Here's a specific quote from him from an interview from the Harvard Business Review in 2007. Bezos said, "When I'm talking with people outside the company, there's a question that comes up very commonly. What's going to change in the next 5 to 10 years? But I very rarely get asked what's not going to change in the next 5 to 10 years. What I like about this quote is it reminds me of Warren Buffett. Buffett is not really a tech investor, and a lot of people know that. What a lot of people don't know is that he actually has a long-standing friendship with Microsoft founder Bill Gates, going all the way back to 1991. And despite their close friendship, Buffett never invested in Microsoft stock. Now, whether or not that was actually a rare mistake on Warren Buffett's part, that is something for another video. But for this video, I want to highlight a conversation that Gates and Buffett had way back in 1991. Supposedly they were at this party and Gates was trying really hard to convince Buffett about the merits of personal computing. And Gates reportedly said, "It's going to change everything." And thinking about that for a moment, Buffett then asked, "Is it going to change the way people chew gum?" Gates said no. Buffett said, "Well, then you stick to your computers and I'll stick to gum." At the time, Warren Buffett was a big investor in Wrigley's chewing gum. You see, like Bezos, Warren Buffett is very interested in investing in things that don't change. He's not interested in whatever is the up-and-coming thing. He's interested in chewing gum. He's interested in grocery stores, the thing that is not going to change, and that is what he built his portfolio around. In the same way, Jeff Bezos built Amazon around things that weren't going to change. In Bezos's insight, people weren't going to change the fact that they were going to shop for things, and e-commerce wasn't going away either. That was something that was very much growing at the time. By simply focusing in on what wasn't going to change over the next decade, Bezos was able to grow Amazon from nothing to a business that, as of right now, is on pace to do $300 billion in e-commerce sales in North America in 2022 alone. This is something that I find true in my own portfolio and something that I believe that other investors would do well to emulate as well. 3 of my best performing stocks over the last 3 years are pretty boring businesses. We have Lowe's, Tractor Supply, and United Rentals. All 3 of these stocks are crushing the market, and they're not curing cancer, they're not splitting an atom. It's pretty basic stuff. Focusing in on what doesn't change is a fantastic way to lay a solid foundation, whether it be business or investing. You may be wondering, what is the purpose of scaling an e-commerce business like this if profit margins are slim to none? That's a fair point, and it is a long-standing criticism that people have had against Amazon stock. However, that brings us to the second part of Jeff Bezos' genius, and that is he shows us how to experiment. So let's go back to the quote that we just referenced about things that don't change. Following the quote on what doesn't change, Bezos then went on to say, "At Amazon, we're always trying to figure that out because you can really spin up flywheels around those things." So Bezos is talking about developing other lines of business around this core foundation, and that is what is known as optionality, the ability to generate new revenue streams. So one very tangible example of what we're talking about is advertising for Amazon. Advertising wasn't a very big deal for Amazon until recently, but now it is on pace to do $10 billion a year as of the most recent quarter. It couldn't do this if it didn't have the foundation of the e-commerce. However, even a better example of optionality for Amazon is Amazon Web Services, or AWS. Through the first 3 quarters of 2022, AWS alone has generated $17.6 billion in operating income. And by the way, That is all of Amazon's operating income this year because both its international operations and its US operations are unprofitable. In other words, even though it's a business that does hundreds of billions of dollars in revenue, it would have zero profits if it wasn't for AWS. Now, AWS didn't come about overnight. It was a successful experiment after many failed experiments, including the Amazon Fire phone of 2014. Okay, so on this point, here's the quote that I want you to hear from Jeff Bezos. Most large organizations embrace the idea of invention, but are not willing to suffer the string of failed experiments necessary to get there. Outsized returns often come from betting against conventional wisdom. And conventional wisdom is usually right. Given a 10% chance of 100 times payoff, you should take that bet every time. But you're still going to be wrong 9 times out of 10. This reminds me a lot of what author Nassim Nicholas Taleb says in his book Anti-Fragile. Taleb writes, somebody with linear payoff needs to be right more than 50% of the time. Somebody with a convex payoff much less. The hidden benefit of anti-fragility is that you can guess worse than random and still end up outperforming. We don't have time to discuss all of Taleb's book Anti-Fragile here. I'll leave a link in the description. But Taleb points something out that has been proven true with Amazon. It's been wrong probably more than 50% of the time, and yet it has massively won because AWS was successful and AWS was a non-linear payoff. AWS's win has more than made up and paid for all of the mistakes. This follows a principle called the Pareto Principle. If you're familiar with it, it basically says that 80% of the outcome is driven by 20% of the inputs. That's true in many things in life. It's been true in Amazon's case, but it's also often true of our own investment portfolios. Peter Lynch says, if you're right 6 times out of 10 in this game, you're doing very well as an investor. Implied in that is good investors are going to be wrong 4 out of 10 times. If you're an average investor, what are you going to be wrong? 5 times out of 10? 6 times out of 10? And yet you can still win as an investor because a stock can only go down what you've invested in it, but it can return many times over what you've invested in. And if the Pareto Principle is true in investing, then you want to be invested in many things to give yourself the chance to be invested in the one thing that pays off in a big way. As you can imagine, however, if you were to construct an entire investment portfolio this way, it could actually take you out of the game. You could be wrong too many times in a row and have no capital left over. Business is the same way as well. I think right now at the stock market in the beginning of 2023, you're seeing a lot of companies that were based around ideas that had big payoffs, but they're not paying off right now, and therefore these businesses are starting to fail because they didn't have the solid foundation to begin with. And that's why Bezos was so genius with what he did with Amazon. Yes, the e-commerce operations were very slim to no profit, but it was a solid foundation around something that wasn't going to change, and from that it enabled Amazon to be able to take small bets in many different things, and some of them are starting to pay off in a big way now, such as advertising and AWS. Portfolio construction can be this way as well. You can have investments in things like Lowe's and Tractor Supply Company, which are very stable businesses built around something that doesn't change and will be solid performers for years and years to come pretty reliably. From there, you can make smaller investments in things that perhaps could fail. You could be wrong many times, and yet finding the few that do very well are going to drive all of the returns in your portfolio over the long haul. I believe it can work in your portfolio just as it's worked with Amazon and AWS. And by the way, if you want to know more about how AWS is really the driving factor of Amazon's business and the stock, you can click this video right here. Other than that, I do appreciate that you watching this whole video, and we'll see you in the next video.